When you get 189 suburbs in Australia, then the next question is how many of those have grown 100% or more in the last decade? 10 years ago, they were at the 500k mark. You follow? And out of 189 suburbs, 87 suburbs have doubled in value in the last decade. 87 of those were 500k in typical value, and they doubled to 1 million, which is 46% of the overall $1 million cohort. When you have in sub 500k areas, you have both investor and owner-occupier demand participating. How big of the owner-occupier cohort is in those areas? Is the entire owner-occupier cohort participating in those areas?
Welcome to Property Banter by Pinnacle Buyers Agents, powered by Hashtag. Today we've got Dr. Matija Djolic from Hashtag with us to discuss the best price points to buy in and what price points are most likely to double. We also get into a few things with regards to property investment. This is going to be a great episode. We hope you enjoy. Welcome, Matija. How's things?
Pretty good, man. Pretty good. I love chatting to you, man, because I'm much more relaxed with you than on other podcasts. I get nervous. With you, I don't. I think it's your aura that makes me comfortable.
Okay, that's fantastic, mate. First compliment of the day. Keep them coming.
How you doing, man? How are you doing? What's happening with you? I'm seeing a lot of stuff online. Business is growing. I'm happy for you.
Yeah, doing a lot of content and enjoying the journey of where I'm at. So just genuinely happy, brother. I'm genuinely happy.
Is it the journey in a sense that the business is growing, or the journey, the inner work we've discussed before, training?
Inner work. It's training. It's changing lifestyle. It's being happy.
When was the last time you had a pizza?
A while ago. I used to eat pizza for breakfast. So, and I can't remember the last time. So it's one of those things where I'm not craving anything. Like I don't eat, no sugar. I'm just content. I'm enjoying what I'm doing. I'm just happy. And I think it's showing in my work. It's showing in life. I think it's just, and I'm just happy. Anyone that asks me, I'm happy. That's where I'm at. It's beautiful.
No, it's great, man. But do you get I know we're digressing a little, but I'm interested in this because I'm big on that, but I'm not perfect in delivering that in my day-to-day life. But do you get those, let's call them voices that want to throw you off the wagon or back on the wagon? I'm not sure which way.
No, I don't crave alcohol whatsoever. I don't crave sugar. It's finally stopped because you know what I've done? I've got a hack. I worked it out. I make this protein drink thing that I put in the freezer and then I put it in an ice cream maker. I bought a Ninja ice cream maker and I just granted I am overeating the healthy stuff now. So I'm still eating a lot more than I should be. And I go over my calories sometimes, but I've worked out just all natural stuff like, banana, date, pecan, protein powder, ice cream, smoothie thing. So I've just changed things. I've just changed things. And instead of, going out, hanging out with the boys and having a drink and socializing, like
you have friends?
Going to the gym. I've got friends. Yeah. Some friends. Listen, let's get into this. So let's get into it. So today we want to talk about, I've forgotten what we're going to talk about. We're going to talk about best price points to invest into right now. What's the optimal price point in the market based on the data, based on the Hashtag data? And look, a lot of my clients signing up, they're between 400 and 650, 400,000 and 700,000, right? That's where it generally is. When I talk to a lot of people in a lot of markets, we are finding that above 800, some markets really aren't moving, but that, anything with a 5 in front of it or a 400 or whatever it may be is rapidly moving. What's your take? What's going on at Hashtag? Talk to me.
All right. That's actually, I've been thinking about this topic for a while and never gotten around to actually do any research on it because, the market says one thing. And what the market says is, when I say the market, like the briefs that we get, that you get, that I get to analyze, etc. It's sort of, most of the briefs, I think 9 out of 10 would be under the 550K range. And I guess the aspect of affordability is the one that's driving those briefs in a sense that people want to get onto the property ladder. They can't afford the 800Ks. And simply because I guess the disparity between wage growth and property price growth has actually been the biggest since 2004. I always say when I moved to Australia in 2000, I used to fill up a shopping trolley with $50, and now it takes me 300 or 400, depending on what I'm buying. If I'm buying the healthy stuff like you, it's probably even more. So, yeah, it's interesting how currency is being debased in a sense that our purchasing power is being eroded dramatically, which is why we get all of these briefs. So, and then you would think that because you're getting most of the briefs in that kind of sub 550 domain, that's the one that's growing the most because most of the demand is going there. But then you need to insert, another thing into the equation and essentially consider, okay, what is the biggest lending cohort? And when you look at the mortgage data, you realize that most of the people getting out loans are the owner occupiers. I think 2 times bigger than the investor cohort. The owner occupier cohort is the biggest cohort, those that are getting the most mortgages out. And I sat down a couple of days ago trying to figure out, okay, determine which price point is best to invest under. And I first have to figure out my reasoning to come to that conclusion. And the reasoning would be, okay, which price points have the most potential to double in value? Now, the price point in and of itself is not an indicator of potential. So, as I always say, it's very dangerous to assume that just because something has a certain price tag, property will grow more or less in value. What contributes to growth is all of the metrics and alignments underneath the price point, the supply and demand indicators essentially, which push the price. However, the budget in and of itself delineates the market possibility. So, for example, when you're investing in a market that's 350K in value or below, there are certain inherent negative drivers, I would say, which are restricting growth in that suburb. I mean, simply you would have average medium income would be lower, socio-economics will be lower, etc., which stop that suburb to actually catapult to the 600 or 800K range, So the budget does delineate the boundaries of possibility, but in and of itself, the budget actually doesn't say anything. It's simply because, let's say, if you're investing under 700K, typical value, usually those areas have better socioeconomic standing, more stable markets. They see less negative growth in the past. They have more diversified industries, etc., So budget gives you some kind of an indication. However, in and of itself is not a contributor to growth. And now I'll share the screen. I don't know how to share the screen here. What I did, I'm just going to go to the platform and I'll share the screen later. Actually, I'll do a screen
record and send us the link, Matija.
Yeah, no worries. So I did some research and I put in. So the way I went about it was, okay, so let's put in areas that are $1 million in value currently in typical price average of $1 million. Let's see how many of them there are, but we have to filter for confidence, because if we don't consider confidence, we are potentially including areas into our list that have medium or lower confidence, which means that the data that we are looking at is not as accurate. And what I mean by accurate is in property is in liquid asset, which means that it doesn't exchange hands on regular basis as does, for example, crypto and shares, which means that its volatility is much less pronounced. And when you have less volatility, when you can actually easily extrapolate a pattern from a high volume of data, and that pattern remains fixed or solid for at least a couple of years, and then it sort of shifts and changes a little as market dynamics change. So when you have high confidence data, you're looking at statistics and data that fixed or firm for extended periods of time. And only those areas you can make, I guess, a judgment call upon, because other areas, let's say low and medium confidence areas, would be too volatile for you to actually extrapolate a rule or reason from it, So if you include areas that are $1 million in typical value, if you filter out all of the medium and low confidence data, you get 189 areas in suburbs in Australia. Yeah. So when you get 189 suburbs in Australia, then the next question is, okay, how many of those have grown 100% or more in the last decade? Which means that 10 years ago, they were at the 500K mark. You follow?
Yep.
So when I do that, and out of 189 suburbs, 87 suburbs have doubled in value in the last decade. So 87 of those were 500K in typical value, and they doubled to 1 million, which is 46% of the overall $1 million cohort. So to repeat, when you filter 1 million price point, we filter for high confidence, we get 189 suburbs. Out of those 189, 87 suburbs have doubled in value or more, which is 46%. Okay. Then we increase the price point to 1.2 million. Why am I increasing it to 1.2? Because I'm trying to determine the 600K cohort. So I've moved from 500 to 600K to see which ones have actually doubled in value. So when I filter in for 1.2 million, we get 94 suburbs that have high confidence. Yeah. So we get less suburbs than those that are 1 million. 1 million had 189 high confidence. 1.2 million has 94 suburbs high confidence. Now, when I filter in the growth patterns across a decade, and I set growth in the last 10 years to be 100% or more, I get 44 suburbs, which is the same as previous cohort. It is 46%, which is interesting. So essentially suburbs that are 500K in value and 600K in value have a similar potential to double in value on the basis of current 1 million and 1.2 million cohorts. Does that make sense? You following?
Yeah.
So that's surprising to me because, again, it's interesting. Data can really disprove your biases. And this is what I always say is, you hear me say this a lot. When we're filtering these days, I don't even consider the names of the areas, the location of the areas. I just let the data speak because I find myself, when I'm trying to research, I find that, let's say if I'm trying to research for someone that I really value, I think it's going to be a huge value add to our business, I want to essentially impress them in a way. So when you have that emotional element of trying to impress someone, when you're filtering or when you're trying to research, your bias is even more pronounced. So when you're looking at, and you're much more concerned you're going to make a mistake and you're driven by fear. And when you're much more concerned that you're going to make a mistake because you want to impress someone, your bias actually amplifies. And because it amplifies, even when you look at a certain area or certain location, you're like, let's say you look at a short list, your bias is telling you it's probably that one. Or and then you get humbled if you follow through the whole process or our methodology, you get humbled in the end that 99% of the time it's not the area that you assume. Now it's the same with price points. I had a bias. I was thinking that surely the 600K areas will have more potential to grow in value than the 500Ks. And it's actually dead equal, And the reason why I assumed that is because what I said previously, I thought that the fact that it's 600K in value as opposed to 500K, there are certain economic drivers within the area that are going to make it, they're going to push the area harder and enable it to grow and double in value at a much faster rate than those that are 500K. And usually what I mean is, for example, the 600K areas have an ERSAT or a socio-economic score that's on average, on percentage base, higher than those that have that 500K area ersatz, So I thought the socioeconomics are going to push it higher. I thought the stability of those markets is better, hence they have, more opportunity to grow. But if we look at the data, it's essentially very similar. Close, it's 46% both, which I was very surprised about. Okay. Now we move on to the next cohort. And I jumped onto the 700K typical value. And I was looking for markets that are $1.4 million in value now. So $1.4 million in value, filtered for high confidence. And I get 63.
Tell me it was 46%. Tell me it was 46%.
No, it wasn't. It wasn't. It was interesting. So I filter. So when I type in a $1.4 million typical price, I filter in only high confidence areas. I get 63 suburbs. And then if I set another condition and I say, okay, how many of those 63 suburbs have doubled in value in the last decade or more, I get 32 suburbs, which is 50%. So it's higher than the 46s. Now, it seems that those that are 700K in typical value have slightly higher capability to grow in double in value, which now when you really think about it, it makes sense because it is mainly, those suburbs are mainly driven by owner-occupier demand, and owner-occupier demand is twice as bigger than the investor demand. Now, let me elaborate on this further. When you have in sub 500K areas, you have both investor and owner-occupier demand participating, okay? However, the question is how big of the owner-occupier cohort is in those areas. And we would have to do research and see, is the full, like, is the entire owner-occupier cohort participating in those areas, or is it only a fraction? So when you combine the two, the investor, owner-occupier, it turns out to be as big as the entire owner-occupier cohort in the 700K price range. So it is interesting that as you're increasing now, I haven't gone to the 800 and the 900s. I haven't done it. Maybe if you want, I can do it now quickly just to see. Let's look at the 800s. Let's do it on the fly. So that means that the price point for 800, if it doubles, it would be 1.5 mil to 1.6 mil, 1.6, 1, 2, 3. If we filter in high confidence areas at these price points, we get 50 areas, yeah? So we got 50 areas. Let's see how many of these 50 areas have actually doubled in value. So we insert another condition. We go to price change 10 years. We say greater than equal to 100% growth. We get 14 areas. That's interesting. So in percentage terms, if I have to calculate the percentage, it's actually less than the 500K and the 600K. So we go 14 divided by 50. We get 28%. So see how it actually drops off? So as you're going, so the 500K and the 600K would be the similar potential. The 700K would have the highest potential, and then it drops off when it hits those higher price points, which makes sense because, again, although those price points are dominated by owner-occupier cohorts, you still have this friction point with affordability at that range. So it seems that the 700K typical values are those that have the greatest potential to grow or double in a decade. Now, the difference between that cohort, that price range and the 5 and 600s is only, so the 700s have 50% likelihood, while the other two have 46%. So there's about 4% difference. Now, we have to go a step further and statistically calculate that significance, what that significance is in the whole scheme of things. But, if we look at, just broadly, there is a higher probability in the 700K range, which I found interesting. As I said, I thought that it wouldn't be like that. I thought the 600K would have more potential there. Now, the fact that 600K is closer to the 700K, you can now continue, thinking about it and produce some reasoning or rules about it. The fact that 600K is closer to the 700K, and maybe you can afford only the 600K, maybe you go for the 600 instead of the 500, even though they have the same percentage. You know what I mean?
Mm.
What are your thoughts on these results?
It's interesting. I'm already thinking of it from a buyer's agent perspective, and I'm looking at it going, okay, if I've got 7, maybe 800 to spend in total, I'd try and split it and find 2 areas. One might be a house with a good data set somewhere, and that could be like right now. Today, I'm waiting to find out if we just purchased a $400,000 house in Mildura. It could be something like that. Then it could be, a nice townhouse in another area with a good data set as well. And that rounds out 2 different assets, across 2 different states, 2 different areas, different data sets, different stages of their cycle. Not only mitigating risk, but the potential for good growth there as well. I'd kind of look at it that way.
I understand. Now let's unpack that. Let's unpack it.
Sorry, my mind goes instantly to the brief and the buyer's agent way of buying more assets.
It's a great call, and let's unpack it. And I don't have an answer, but I was thinking about it this way, and I guess it warrants a pen to paper calculation. But I'm thinking about it this way. So, yes, I understand the notion of diversification, but if you're finding an area where you're going to enter before it actually becomes a hotspot, you find that sweet spot, if you will, where you're going to maximize the full momentum of growth of a hotspot. I'm not talking about any value add opportunities now. We're not discussing that, And by the way, the value add opportunities should be taken into question. That's probably for another session. But I think the value add is much more pronounced at the higher price ranges. Would you agree with that or not? And when I say a value add, I'm talking about room addition, something cosmetic, etc., not a complete development.
There is more money to be made at the higher price point doing bigger things. It's kind of like doing a 6 townhouse development. Like a 6 townhouse development would require
Yeah, I'm not talking about that because that's a completely new discussion. But what I'm referring to.
It's the same type of thing, Matija. You know what I mean? If I'm going to project manage a renovation on a $400,000 property, and I'm going to go, new kitchen paint, room addition, it's going to be the same amount of time as it's going to be for $1 million property, right? But the $1 million property is going to yield better gains.
And where are you going to get better gains? I think you're going to get better gains at the higher price points, because I think as soon as you have a higher price point, you have definitely higher potential for room disparity between 3 and 4.
100%. And this all comes down to the client and where the client's at with how much money they've got and where they're at in what stage of the cycle. And if you're starting out, you got to start out lower. That's just where we all start.
Absolutely. Now, coming back to your observation, if you had the 7 or 800K, would you split it in 2 purchases? Now, it's always hard to split it 800K into 400K, 400K purchases, because you have sales cost, acquisition costs that are not going to make it as even as that. It doesn't work that way. But let's assume it does work that way. Why would I, and this is my question to you as a buyer's agent, I don't know the answer, why would I bother myself with splitting when I can get an 7 or 800K asset, which still has the potential to grow in value and double, which means you have a single purchase, single risk point. If you enter at the right area of the cycle, why would I spend more money on acquisition costs? And when you say diversifying risk, that also means creating 2 friction points there that could potentially carry risk as opposed to 1. So I'm not, honestly, potentially warrants a calculation to see what is better, and obviously making some assumptions when it comes to growth just to see where you're going to get more at the end. But, I'm not sure whether it's the right move to split it in 2.
Well, that's it. It comes down to your risk profile. Now, let me ask you a question. Do you have different types of crypto in your portfolio?
No.
You don't. You have one. So you got all your money in one.
Correct.
Why is that?
That's a great question, man.
We're going to go in a whole nother rant.
Yeah, that's a great, but it's pertinent to property because it's all economics. Now, I do believe that the markets are shifting. I think the notion of diversification actually is an old way of investing, which lowers your returns. Now, what we need to take into consideration when it comes to property and any other asset class is that the returns that you're making are not real returns. And let me explain what I mean. Now, because of the debasement of currency and inflation, I think use America as an example because I got the stats for America. I think including debasement of currency means erosion of purchasing power. You can buy less in Coles. My previous Coles example. I think the currency is being eroded in US by 8% a year. Plus, on top of that, you got consumer price index of about 3%. So essentially, optically, if you're making 11% on property or any other asset class, you're not making money. You're making 0 returns because the currency and the CPI adds up to 11.
God bless leverage. That's why we
No, absolutely. Now, that's another discussion, but let's just speak about it in economic terms, in a sense that, so in order for you to become wealthier, you need to make more than what the currency and the CPI index are doing. So this comes back to diversification. Index funds, for example, index funds used to be a way to diversify and minimize your risk. But index funds, people are not thinking about the debasement and CPI. Index funds are returning 4 or 5%. So actually, by investing in an index fund, which is a highly diversified fund, you are having much less risk, but you are actually getting poorer, which now brings into question the notion of focus and centralization of your investments. So it becomes now, because the game is changing, and the game has changed after 2008 crisis, the financial crisis, when the banks have been bailed out, and they've been bailed out. And after that, we see an enormous amount of printing. And this is when the debasement started. Yeah. So in order for you to beat market average, you have to make very highly focused, decentralized bets as opposed to diversify. Now, coming back to property, and this is not me speaking, this is, fund manager speaking. And I educate myself in that, and I listen to and read a lot of books on that, simply because, it can be transferred onto the notion of property. So now when it comes to property, is it better to diversify just for the sake of diversifying, or make those highly centralized bets? Put all your money into a basket that will yield the most returns. And now in property, when you're building a portfolio, you're bound to diversify in a sense that you will buy in areas because you're buying at different time frames, at different points in time, you're buying in different states because of their movements in cycles. So, for example, if you were buying 4 years ago, your best bet was WA because it was in that position in the cycle, it will grow the most. Now, if you were buying a year and a half ago, 2 years ago, your best bet was Queensland. Now, the question is, if you're buying now, your best bet would be Melbourne. So you're bound to diversify. But my question is, when you're purchasing and you have more money to buy more property, why would you diversify? Why not make those highly centralized bets? Sorry?
All right, that's an interesting one. Firstly, I don't know why anyone would invest in index funds.
Let me just give you a conspiracy theory, and I know you love them.
I was trying to hold myself back from starting it.
I'll tell you now. Index funds have been created by rich people to make us plebs poorer.
Oh, mate, the whole system is to make us poorer. That's why we're talking today.
Correct. And the main thing is education and understanding that you have to beat market averages. Now, coming back to your crypto question, people will say, okay, if that's the case, why don't we all invest in crypto? Why are we sitting on this podcast talking about property? And you said something beautiful. Leverage is wonderful. You can't have the same leverage in crypto and asset classes as you do in property. So that's why property is still at the top of the hierarchy. Now, for those who have small amounts to invest, 100 or 200 bucks, well, maybe the DGen crypto bet is the way to go. This is not financial advice, but I'm saying the game, you need to know how to play the game, and the game is beating market averages. And what are market averages? I don't mean market average, the average return in Australia is 5%. No. I don't mean that. I mean, you need to beat the debasement of currency and CPI returns. Or negative returns. So if in Australia, it's not the same as in America because we're not printing as much money as America does. So let's say if your sum between debasement of currency and CPI is about 8%, then you need to beat the 8% mark with leverage in order to become wealthier as opposed to poorer. A lot of people are making some returns on property, and that's all only optically. This is why when you're thinking about compounding and your average compounding rate, it should be high. It should be higher, which is why timing market entry is pertinent, because if you're relying purely on compounding and you're entering at willy-nilly at different points of the cycle, you're not actually timing your entry. Let me explain what I mean. If you time your entry and you enter a market before it becomes a hotspot, and then the market actually booms for 3 or 4 years and delivers on average plus 25%, it's increasing your averages. So when it actually drops off to 2 or 3, because you collected that full cycle of the hotspot, it has increased your long-term average. And your long-term average should be above the debasement and CPI index collectively. Otherwise, you're only optically getting richer. But in essence, you're not getting richer. You're getting poorer.
Yeah. So the way I look at it is like this. You want to mitigate risk by buying more assets. So if I could, let's say I was starting out and I had the knowledge and I had 700, 800,000, I'll try and split it and I'd buy myself something under market value and I'd go Melbourne and we'd be looking for that longer term growth. But I could also squeeze out some money and buy myself a property in an area with a good data set that's not Melbourne. And like, for example, the 350 grand house in Mildura, 400K house in Mildura, and I'd get capital growth sooner rather than later, right? And I'd mitigate risk by ensuring that the property, that half of my portfolio, that my portfolio is split into two, so that, if obviously, one of the properties is vacant, there's only a certain portion of my portfolio that is vacant at that time as well. And I'd be using the same data set, funnily enough, that you're talking about, that you'd be using for your entire $700,000 investment. And over time, it would, it'd perform really, really well. But we'd be splitting the two into something that's more of a hot spot and one that is a warm spot.
Yeah, understood.
That's how I would do it.
No, I understand, and it's sensible. And by the way, that all comes back.
I'd use HTAG as well.
Well, if you don't, man, why are we having this discussion?
So that's how it's.
I'll put the hashtag.
And of course,
I'll put this hashtag shirt on.
Yes, there's the logo. There's the logo. There's the plug.
It's the old logo. I got to do new merch, by the way. So you know what it is, Michael. So as you know, it's all good and well to discuss about the best case scenarios. However, our financial circumstances, our briefs, and our strategies dictate where we can buy. And sometimes you have to make compromises. Sometimes you have to make compromises and invest in those areas that are either in hotspots or that are not there yet, or it'll take a bit of time, 4 to 5 years to become, etc., or under a certain price point, all of that. Now, we're talking about a perfect scenario where a client has any amount of money to spend, and it seems that 700K is the better bet. Now, again, depending on their circumstance and the portfolio building strategy, maybe splitting that 700 into something there, Mildura wise, 2 of those is a better option. And I guess that's a very pertinent observation. I think it's very important that clients sit down and understand how one purchase fits into the collective of purchases that they're about to make. You can't just think about a purchase in isolation. This is why the notion of diversification was invented, essentially, because you're diversifying to minimize risk for long-term wealth creation. So you need to think about this purchase in the context of your strategy, your needs, and your goals, and that will drive and shape what is best for you. We are speaking about properties and price points in vacuum, essentially. We're giving no context to it. So yeah, I mean, it's I think in anything, I guess we touched about a few points and subjects, and I'm very big on education. I'm very big on having the capacity to make your own calls and questioning everything, but not questioning in a heckler kind of way, just to get a kick out of it because, you get a dopamine hit. But, just questioning things and trying to, build an understanding and knowledge for yourself. And I would always suggest to everyone now, we're sort of digressing, but I remember my supervisor when I was doing my PhD, and the topic was on, identity and anxiety, relationship between. And he said to me when I started, he goes, Matt, don't just read things on that. Read widely. Read mathematics. Read, because, when you read widely, you get ideas from different domains, from different disciplines, that you can actually amalgamate into a coherent argument and knowledge base that you can use in any domain, whether it's property, crypto, etc. So I think it's important for people to understand and educate themselves on what their potentials are, what their possibilities are, what their financial circumstances is, how market works, how market functions, the psychology of markets, how you can actually build wealth, all of these other things before they start investing and understanding property, because that's going to save them a lot of headaches, simply because what we see today is that you get, like, I have guys, for example, in some of our members, as you know, I mean, you're there all the time and you see my comments. It's like, oh, what do you think about this area? And it's the same. What do you think about this price point? And my always answer to that is in relation and comparison to what? Under what circumstance? It's all contextual.
Oh, what's your brief? What do you want to achieve?
And that's the beauty of it, though, by the way, because, you live in a universe where you're the center of it. You're the main person that you need to understand, and which is why, I always say a hotspot for me is not a hotspot for you. It doesn't work that way, which is why and I don't
for opinions, Matija. They need to stop asking for opinions. The biggest thing I hear from people is that they jump on a strategy session with me and they'll tell me about the guy at work or the uncle or the family member that told them this area is no good, or that they need to be buying because of it.
We spoke about this, and you saw in Mastermind as well. That happens all the time where, the lady that comes and says, listen, I try to, and God bless her in a sense that I do understand when trying to invest in property, it's a big outlay. And I love to see people who don't dive in willy-nilly from the online gurus that tell them invest here. They actually are very concerned about the outlay they're trying to make. Now, you can be concerned, and you can go into paralysis analysis, so that you need to have a method and a thesis on how you're going to get to a particular purchase. And that's very important. It comes back to my argument about education. But we see it all the times where people get swayed and persuade about investing in a certain location or not investing in a certain location just because somebody says. Like you saw online discussions about Cairns and how Cairns is a shithole and how Cairns is this and Cairns is that. Now, what's important about that observation that Cairns is a shithole, and part of my profanity, is that, you're already inserting emotional bias into that observation. Cairns is a shithole for who? There are certain people that have only ability to invest in certain areas, and they can't invest in blue chip suburbs, if you want to call them blue chip. but they want to get onto the property ladder. And it comes back to my observation that you need to pick what is best for you under your circumstance. Will Cairns return? Absolutely will. Well, you know that we spoke recently, and I said, can you help out this lady regarding Cairns? And you put me in my place, and you said, Matt, there's 50 people building for the same house in Cairns. How am I going to find real estate there? You know what I mean? And do you want to? Do you want to anyway? Because you're going to be overpaying, even if you can.
Yeah, that's the thing with hotspots that are double-digit, big-time double-digit hotspots, 25% per annum. We're seeing 20% jump in 3 months in Cairns, right? So it's absolutely crazy. People are overpaying everywhere. But I think going back to the human mindset, I think we have a problem where when it comes to financial advice or property advice, it's acceptable to accept property advice from someone with no knowledge if they are family or if you respect them or love them. They might not have a fucking clue about real estate, but because you respect them, you will listen to their opinion, but you won't listen to an expert. It's kind of like, hang on, let's say take a heart surgeon, for example, but they'll go to see a heart surgeon. The heart surgeon will say something and they'll listen to that heart surgeon, but they wouldn't accept any friends and family advice when it comes to, hey, I think you should do your heart surgery this way. That wouldn't come into play. But when it comes to financial advice, we are often listening to friends and family, and friends and family don't have a freaking clue.
Man, let me give you another, well, it's not a conspiracy, but a conspiracy observation. I think social media has given a platform where everyone can have an opinion.
Including property advisors who don't know their elbow from the arsehole.
Everyone has an opinion on social media. Everyone has an opinion, and everyone is a property guru or a self-help guru or a life coach. Or, mate, we live in a world where an influencer is a profession. Like, how crazy is that? You know what I mean? Like, think about it. I'm an influencer. What have you done in your life? Because you've got so many followers and people listen to you. It is crazy, man. It is crazy. I have studied for 20, and listen, this is not an ego play, but I have to say it. I tried. I never speak about my life, or not. I tried to limit discussions about what I do and how I do it, because to me that is childish and infantile. It is infantile to me to actually speak about all your achievements. I wasn't raised that way. But mate, I've been studying for the last 20 years. Not having a social life. My friends have nearly abandoned me. I was putting in the work and doing and reading, and everything that I say is from all of that investment that I've made. You have been investing in property. You had 15 properties in your 20s, man. You know, like, do you know what I mean? And you don't advertise that enough. And social media has given a platform where everyone has an opinion. Shut up, go do something. No, I'm being serious, man. And because everyone has an opinion, we are in a circumstance where people get swayed by shiny brochures, in a sense that, how a person appears. If I have abs and good biceps and I go on Instagram, people are going to listen to me more. Somehow, inadvertently. Or if I look good as a female, if I do this, if I do that, I can promote a product and that product is going to be purchased. Now, that's human psychology. I shouldn't be naive and disregard. I have the same human psychology. We function in the same way, which is why, let me go back, and I said this in the mastermind, the game of investing is an internal journey. It is a self-reflexive journey. And Warren Buffett actually talked about this. And he coined the term, be greedy when others are fearful. In a sense that you have to eliminate biases. You have to understand. I'll give you an example. Do you know, and this is what Warren Buffett said, and when you really think about this, it is a phenomenal observation. He said that, do you know that when most of the people promote a particular share or an asset, it is because they're already invested in it. Not because they're trying to pump it, but because they're trying to justify their own choices. Because when you don't justify your own choices but affirming that that's the best thing, your identity crumbles. Your self-identity crumbles, and you can come to a position of despair. So we continually go through life to try to affirm what we do and try to justify and say that is the right move, because otherwise we lose ourselves. So that is normal. I understand that. But when you look at that psychology, when somebody's pumping an area, know that they're already bought there. That's why they're pumping it. Some of them do it because of malignant reasons, in a sense that they want to pump their bags, and we have a lot of those. But some of them just do it because they're bought there. And they're like, okay, because the mind works in this way. Because I bought there, it must be correct. And you need to be self-reflexive to understand that you're making that call. That's a subconscious game. You need to go back inside and go, okay, why am I thinking what I'm thinking? So you do that for yourself, but you also do it for aligning with other people's opinion. So when somebody says something is good, think about it. Why do I think that that is good? What is the reason? And the root cause of it is something personal as well.
That's the same with listening to friends and family. You listen to friends and family and their opinion on where you should invest and what area is good and what area is not. And Brisbane's a flood zone and Perth's a mining town and whatever. That's because you heard it from someone else, or someone bought a property in Brisbane 10 years ago and they didn't make money. That's that, like I've heard these are actual comments, and people seem to value them because they come from someone they value, and that doesn't make that person an expert. That's part one of our episode with Dr. Matt. We have a part 2 coming up shortly. Stay tuned. Thank you for joining us on Property Banter. Please like, subscribe, share it with a friend, and we hope you have a good day. Cheers.